this on-demand video, OJM Group Partner Jason Odell outlines 5 key success factors you should look for when choosing permanent life insurance as part of your long-term wealth plan. If you have more questions or want to learn how to incorporate life insurance into your financial strategy, click the link below to schedule a complimentary one-on-one consultation with one of our experienced team members.
Welcome. Thanks for joining. Today's topic is 5 key success factors when using permanent life insurance. We'll also have a case study at the end. Prior to getting into that, I want to distinguish between permanent insurance and term insurance. Term insurance is insurance that provides a death benefit for a period of time, 5 years, 10 years, 15, 20 years duration. During that period of time, usually the premium is level or remains the same, provides a lump sum death benefit in the unfortunate death of the insured. And during that period of time, if you make the premium payment, the insurance is in place. It's like your auto insurance. You pay the premium. If it's an accident occurs, the insurance company's there to pay the claim. If it doesn't, they're not giving you any of your premium back. You move on to the next year's premium payment. If after a period of time or during the term, say at the end of 15 years of paying premiums, premium typically will go up so significantly that you will just cancel your term insurance. Not in all cases, but in most instances. Term insurance has a great tool to use while there are short-term needs for cash in the event of an untimely death, such as replacement of income during your kids' early years, paying for a debt that you would have that you wouldn't want to burden someone with if something happened to you prematurely. Today, we're going to focus on permanent insurance, and the case study will really focus in on 5 key factors. So you've got long-term time horizon with permanent insurance. We're going to talk about how you design a policy and how it's important to have excellent design upfront with lots of flexibility. We're going to look at review and maintenance and also talk about finding the right person to put together and design an insurance policy. And then we'll get into what's called a 1035 exchange opportunity. For those of you that do have permanent insurance in place currently, maybe there's an opportunity for you to look at potentially utilizing a better product or type of insurance than you currently have in place. There's a long-term time horizon with permanent life insurance. Permanent life insurance is not something you want to put in place with the idea that you want to only do it for a short amount of time, and you're only going to access or want to access the cash value in a very early period of time. Normally, what is recommended is that if you're going to purchase permanent insurance, it's going to provide a death benefit. The premium is going to be higher than term insurance. A portion of that premium is going to go into a cash value after the mortality charges and expenses are paid. And then that cash value is going to grow. And how that cash value is going to grow is what makes permanent insurance products different from each other. So you have a number of different types, from whole life to universal life to variable life to index universal life. And the main difference between all of those is just how does the cash value grow during that period of time. So permanent insurance is going to require a long-term time horizon that you're going to make a premium contribution every year. And then usually about 10 years after you've been making the premium contributions, it might make sense to start taking distributions from the cash value of the policy. And you'll be taking normally distributions over a period of time. Doesn't mean you can't take distributions from the cash value earlier than just a long period of time. You could do some chunks of it, but normally over a period of time, it makes the most sense. If you need access to the cash that you're putting in premiums in, say, the first 5 years, or you've committed an amount of premium dollars that crunch your budget, it's not the right tool for you. You want to make sure you're able to fund this well enough so that you can then access the cash value in the form of distributions at some point 10 years greater than now. The other benefit of permanent life insurance is the tax features of it. Permanent life insurance, the cash value, it's an after-tax premium that goes in, but the cash value grows tax-free. So you do not pay any tax as the cash value is growing. You can pull distributions through withdrawals and loans out of the policy tax-free as well. And the death benefit passes on to your beneficiary tax-free as well. So you've got significant tax benefits with cash value life insurance if it's properly designed. And that is the key. It needs to be properly designed. In addition, in about 21 states, it is exempt from creditors by state statutes. So you can have as much money in the cash value, and it's exempt from any creditor. So that makes it a great asset protection tool as well. But again, the proper design up front is very important. You want to make sure it's based around your goals and your objectives. So what is your funding amount? How long do you want to fund it? What is the funding time frame? How long in the future do you want to then start taking distributions out? And then comparing that distribution stream as if you wouldn't do the insurance and you would buy term and invest the difference, where would you get more money out? So showing an economic model that would potentially validate that the cash value life insurance makes the most sense. And the way to do that is really compare cost of insurance charges to taxes, right? Those are the two things that you have in the model that you can look at or make some assumptions about. You also want to make sure you have the right amount of death benefit. Death benefit is what drives the cost of insurance charges up. So every year, when you're making that premium payment, you have cost of insurance charges. You want to get a lower amount of death benefit if you're building the policy for accumulation features, or if you need it for long-term estate planning. You want to make sure you have the maximum amount of death benefit with the lowest amount of guaranteed premium to keep the policy in force to, say, age 100. You want to, again, designing it for flexibility is so important. You want to have the flexibility to change the premium contribution if you need to in the future. Some life event happens and you need to lower the contribution. Some life event happens, you want to increase the contribution. You want to have that kind of flexibility with the life insurance, with permanent life insurance. You want to have flexibility in choosing the underlying investments and how the cash value grows. The typical permanent insurance products we like to utilize are index universal life or variable life insurance, because those underlying investments are controlled by the owner of the policy or the insured of the policy, and they get to select from a list or menu of indexes or mutual funds, and that's how their cash value grows, thus taking it out of the insurance company's hands, putting it into your hands, versus whole life insurance where the insurance company controls how the money is going to be invested and they return a dividend to you. We'll get into an example here in a minute about that. You want to have flexibility of the death benefit and obviously flexibility to be able to change the beneficiary. Can you move beneficiary if something happens, a life event like a divorce happens, changing a beneficiary if you're allowed to, or you want to move beneficiaries, split beneficiaries, you want that kind of flexibility. So make sure you're designing the policy upfront for that. Regular reviews and maintenance. So you want to make sure that the policy, just like any other asset that you would own, is reviewed regularly. Annual reviews are what we recommend. So every year we're reviewing our policies with our clients, going over them. How did it perform versus our original assumptions? Do we need to make any changes to any of the underlying investments, any changes to ownership, beneficiaries? What needs to be done? And every year as you're doing that, you're treating it just like you would any other asset. The other thing is we want to make sure that you're having an ethical and sophisticated insurance agent design and build a permanent life insurance policy for you. This is probably the most important of all of the 5 factors we've talked about. You want to make sure the agent's not, or firm is not captive, meaning that they can only sell one product. You want to make sure that your product is shopped amongst multiple insurance carriers to see who has the best product based on your particular situations. Could be a health factor that could cause different carriers, could be carriers with products with less expenses than other carriers. Not all carriers are built the same. So this is crucial that you have a sophisticated insurance agent that can design this. More often than not, this is where we see the biggest issue when we review policies, is that the insurance agent was captive to one insurance company. They sold one insurance company's product to the individual, and when we're reviewing it, the product was not designed properly, had high commissions, and didn't make a lot of sense for what the goals were of the particular client. Give you an example in a case study. We have Bert here that wants to look at improving his current whole life product, maybe doing something what we call a refi or a 1035 exchange. 1035 exchanges are in the Internal Revenue Code. They allow from They allow a like-kind exchange from one permanent life insurance, removing the cash value and putting it into another life insurance policy. So having that cash value move from one insurance company to another insurance company with no tax ramifications. There's only one other area in the code that allows for this kind of exchange. That's a 1031, which is for real estate. 1035 exchange is for life insurance. So Bert purchased a whole life insurance policy at age 40 from a very well-known life insurance carrier. He's now 52. He's curious about this 1035 refi exchange that's there. His carrier that he has in place is a solid one. Their whole life product is a great whole life product. It's also one known in the industry to have relatively high expenses and charges and significant costs to borrow money out of the cash value when you want to take a distribution. At the time, Brett was super preferred when he got the policy, but he's also maintained good health still at 52. So when we modeled it out, if he were to 1035 exchange his whole life policy to a index universal life policy with another top rated company, he'd actually get significant improvement. At 52, Bert being a preferred risk, we assumed a 5.85% rate of return for both the current whole life product and his new indexed universal product that he's reviewing. His distributions that he could take out starting at age 65 for 20 years were $53,696. With the same assumptions, the distributions from the new index universal life policy would be $98,476 for that same time frame. That's a $900,000 increase in distribution over that 20-year period of time. It's a significant improvement at the same rates of return based on the ability to access that cash value more efficiently than the whole life product and less expenses, cost of insurance charges. Dramatic improvement. These are the factors I just mentioned. You've got cost of insurance charges, COIs, moving from the whole life insurance to the index universal life product are lower. You've got the ability to access the cash values more efficiently. From what most makes sense, if you own a permanent or cash value life insurance product, you should at least have it reviewed to see if considering a 1035 exchange or a refi to a more efficient policy makes sense for you. We would encourage you to examine your options. Thank you for joining me today. Look forward to speaking to you if you have any questions about this.
OJM is a multidisciplinary wealth management firm. For nearly 2 decades, our firm has helped physicians across the U.S. reduce taxes, protect assets, and achieve their financial goals. OJM Group offers viewers a complimentary consultation where we can answer your questions to see if our firm might be a good fit for your situation. Simply click the button below to schedule your free consultation. We hope to speak with you soon. Thanks for watching.